Yes, sir.
Yeah. So we are going straight away into the management control systems. But before we move into
Okay,
the
sir.
management control systems, what do you know about the
Okay.
internal control systems and what's the difference between internal controls and management controls?
Okay, sir. Okay, sir.
What do you know about internal controls, Kumar?
So
What
come
is
again,
it?
sir.
What is internal controls?
So internal controls the procedure made by the management
Mhm.
uh, to control the activities of the business, sir.
Not to control the activities. If you control the activities of the business, that's not good, right?
Okay, sir.
Basically, we run an organization to achieve
Okay.
our objectives. So the
Yes,
internal
sir.
controls are basically a big part of the whole thing that is there.
Okay.
Basically, the
Uh-huh.
idea is to ensure that we work
Okay.
according to some uh,
Mhm.
kind of an orderly
Okay, sir.
manner in the sense that, because of the internal controls only, you go to office at 9 o'clock in the morning or whatever the time they
Okay.
ask you to come. Because of the
Okay,
internal
sir.
controls only, you go in a proper dress. Because of the internal
Okay, sir.
controls only, you will take your lunch at a particular time. Because of the internal controls only, you will take the holiday on Friday and come back to office on Sunday.
Okay, sir.
So one is to see that the organization works in an orderly manner. The other one
Okay.
is to ensure that the organization people will
Mhm.
adopt to the will adhere to the company policies and procedures.
Okay, sir.
Right? Now, in your company, in the company where you are lecturing, they might say that for
Okay.
the students they give 30 days credit to pay. So after 30 days,
Okay.
they must pay.
Uh-huh.
Right?
Yes,
That's the
sir.
company policy. Company policy is
Okay.
before they give any tuition, they may be wanting the money in advance. So that's a company
Mhm.
policy. So the control
Mhm.
systems are there to ensure that the company policies are properly implemented.
Okay,
Also,
sir.
in a way,
Mhm.
it protects, it minimizes errors and frauds because
Okay, sir.
because of the control system, it is been prepared by one person, checked by another person. It goes to a process
Mhm.
of controls. So the
Okay, sir.
chances for error is rare. Chances for a fraud is
Okay.
rare. And
Okay, sir.
because of the control systems, we protect our assets, right?
Okay,
Assets,
sir.
so that there is a proper maintenance of assets, proper insurance of assets, all that kind of a thing. Because of the control
Okay.
systems, we maintain our data confidentially. We give
Okay, sir.
passwords to every employee
Mhm.
so that no one can access the other person's computer and find out the information what is in your computer. Everyone
Yeah.
is given a user ID, everyone is given a password. They have to use that one too. So like that, there are many purposes of control.
Okay, sir.
That is what the controls are made. So
Okay.
risk
Mhm.
management, you said, basically
Mhm.
risk management you
Mhm.
have done. Now risk management, what are the 4 ways to manage the risk? What are the 4 ways to manage the risk?
4 ways to manage the risk, sir.
Yeah, yeah.
Tara, sir. Tara.
Tara,
Transfer,
yes,
accept,
that's right. Yes. What is that? Transfer,
use, and
avoid,
right.
reduce, accept.
Yes.
Right?
Yes, sir.
Some risk we transfer.
Yeah.
What do you mean by transferring? We take insurance cover.
Yep. Yep.
Certain risk we avoid.
Yes, sir.
Certain risk we
I,
reduce. How do we reduce the risk?
so we implementing the internal controls and
Right. Yeah, we by
yeah.
implementing internal controls, we reduce the
Yes, sir.
risk of a fraud happening. We reduce the risk
Yes,
of
sir.
a error happening. We reduce the risk
Okay.
of something going wrong. Right. That
Yes,
is
sir.
why we have proper
Yeah.
maintenance on schedule, so that we reduce
Yeah.
the risk of machine not working suddenly. We right.
Yeah.
That's why we keep the
Yeah.
computers in a place where there is no smoking and all that. We reduce the risk of a
Yeah.
fire.
Yeah.
That's the way to reduce the risk. So one way is to, the big way is to
Yep.
go through by internal
Mhm.
control. So now we are
Yes, sir.
talking not about the internal control, we are talking about what we call management control. What is management control?
Okay.
What is management? Now, what is the organization? When you say organization, you have business organizations. Okay,
Yes.
let me put it like that. How many types of organizations are there in the world?
Sir, in general, three, sir. Sole
Yeah.
trade, partnership, and joint stock companies.
No, not really.
Uh-huh.
First of all, let's talk about an organization. What is an organization?
A group of people,
Yes, coming together.
yeah, for to achieve some objectives,
Yeah,
specific
coming together
objectives.
to achieve common objectives, a common objective.
Yep, yep.
So you think
Yes, sir.
the sole proprietorship all right, partnerships all right, limited companies all right,
Yeah.
but what about the
Okay.
others who achieve common objectives like government? Government is not a
Okay, sir.
partnership. Government is not a limited company, right? What about the
Okay.
charities?
Yeah.
Charities is not a partnership,
Yeah.
right? So there are
Yeah.
broadly three kinds of organizations we find in this world. One is what we call profit-seeking organization. Profit-seeking,
Okay,
not
Yep.
profit-making, profit-seeking. The idea is to make a
Yes.
profit. So the sole trader,
Yep.
the limited companies, the private partnerships, everything falls into that category.
Yep.
Profit-seeking. Then what is the next one?
Yeah. Non-profit
Not
organizations.
for profit seeking. Like charities, societies, they have definitely a different objective to provide some work to the community or something like that. That is what we call not for profit seeking. What's the third one?
Third one.
Third one is the public sector organizations,
Okay,
government.
sir.
There are certain things
Okay, sir.
done in any country to the government, public
Okay, sir.
sector, right? So these are the three
Okay.
types of organizations, and each of these organizations, what we see is there is a set of people coming together to achieve a common object. Maybe
Okay.
to seek profit, it may be to provide charity, it may be to run a government or a country.
Okay,
Now,
sir.
whatever the organization, there are in every organization we have to have systems. Every organization work through what we call a system. What is a system? System is every organization get an input, whatever the way, they process it and they put out a output.
Okay, sir.
That's what all the organizations are doing. Government
Okay,
gets
sir.
lot of people, government servants, that's their input,
Okay, sir.
and then they do a lot of work, and then there's an output given to the public in form of transport, in form of postal or whatever it may be. Businesses,
Okay, sir.
they take the raw materials, labor, everything as input, they process and give a product, goods or services.
Okay.
Charities, they collect some people and do some work, community work or something, and that's a process, and finally there's output coming up. So remember, that's what basically we see. And all these things, what you can see is we are dealing with people. Without
Okay,
people,
sir.
there is no organization. And because we have people, we need to have certain controls. Certain controls. Because the people need to be controlled to achieve the objective. The people have a big freedom, a free choice. They can do anything, whatever they want. And if they do whatever they want, the organization may not achieve its objective. So for that purpose, we need to have certain systems to bring the controls. The idea of the controls is to see whether we are working on the right direction, right path.
Okay, sir. Okay,
That's
sir.
what it is. Organization is a system where people combine to carry out whatever the objective for which the organization exists. Control is a way that we should function, the organization should function. So there are set rules and procedures, everything put up so that it will finally meet its objective.
Okay, sir.
System is ultimately, it takes input, convert it to a process, and finally it produces our output. This system, any system, computer systems, purchasing system, sales system, what financial system, what is the financial system input?
Sir, financial system?
Yeah, what is in your financial accounting system, what are the inputs they get?
Sir, data, sir.
Data, all the data they collect it and they process it
Yep.
and they provide
Yep.
what? Information.
Yep.
They provide
Yes,
financial statements. Financial statement
Yes,
is information. Information for people
Yep.
to make decisions.
Mhm.
That
Okay,
is
sir.
what the system is all about.
Okay, sir.
Basically, there are a couple of system theories, what we call a subsystem. Subsystem. Subsystem is within the system, you have many other subsystems. For example, if you look at the finance, inside the finance,
Okay,
there
sir.
will be many subsystems. Costing section,
Okay.
financial accounting section,
Yes, sir.
treasury section.
Yes, sir.
Like that, there will be many, many subsections.
Okay, sir.
Then, what is a closed system? Closed systems means it does not take any input from the environment, neither it produces anything to the environment. Can there be a closed system anywhere where you don't simply interact with the environment? We all know we interact with the environment, isn't it?
Yes, sir. Yes, sir.
Yeah. Can there be can you think of any institution that is sort of working in a very closed environment? No interaction with the outside world.
No, sir.
Impossible, isn't it? In the
Yes,
old days, long time back, the prison system was something like that. The jails.
Yes, sir.
Yeah, people, they don't, the convicted prisoners, they are kept in island. They don't interact with the environment. No one can come. They have to produce their own thing and, they have to live in that way. That was kind of a thing. But today, the businesses cannot work in a closed system. Businesses will have to work on an open system. Open system is we interact with the environment. So any system finally must have some objectives. Right? Objectives, every system. Now if you look at the credit control system, it has the objective to ensure that all your receivables are paid within 30 days or 60 days. If you have a purchasing system, you have objective to ensure that all the goods that the company requires is available on the time. If you have a just-in-time system, where the system is that the goods must come when the goods will be produced when the customer wants. So every system should have an objective. There cannot be a system without an objective. And that objective need to be achieved, and therefore it needs monitoring and controlling. So every system need to be controlled. If not, the system will go out of control. So you will see some companies, when they don't have proper control system, the things go out of control. People will just go and spend. Now, if you look at the budgetary control system, what is it? It's a control system. Right?
Yep.
You have to work according to the budget.
Yes,
so you are given a budget, you must work within the budget. If you don't have a budget, if you don't have a control system, people will go out of control. People will spend whatever the money they want. If you don't have internal control system, everyone will start signing checks. So when we don't have controls, it's difficult to run a company, to run an organization, and to meet its objectives. There are two types of controls we are talking about. First one, feedback control. That I am sure you must be knowing. What is a feedback control?
Feedback control means based on the feedback, we will implement the controlling procedures, sir.
Yeah. What do you mean by based on the feedback? What do you mean by based on
feedback means based on the feedback. Feedback means suppose if when we are doing something, we will take a feedback. After finishing the work, we will take a feedback.
After finishing, you compare the actuals for a particular period with the planned thing. Look at the variances, and then you take corrective action for the future period so that you will fall in line. So this is what the
Yep.
our monthly management accounting is doing. We go through a set of
Okay, sir.
variances, right? And then we see, okay,
Yes, sir.
sales have not achieved its purpose. So then we tell our sales people, you all have failed in the first quarter, try
Okay,
and
sir.
improve it in the
Okay,
second
sir.
quarter. That's one.
Okay,
So
sir.
it is a basically what we call a reactive control system. After getting
Okay.
the feedback, we react.
Okay, sir.
What
Yes,
is a
sir.
feed forward?
Feed forward means before completing the activities, sir, we will come to know what will happen in
Now we
future. So
forecast.
we will align. Yeah.
We
Yeah.
forecast. We want to
Yeah.
see
Yeah.
whether we
Yeah.
have a plan to do something by March. Are
Yeah.
we going towards that plan according to our present latest forecast? If not,
Yes, sir.
we
Yes, sir.
see a gap,
Uh-huh.
and then we will try to
Uh-huh.
see how that gap can be
Yeah.
made before it happens.
Yep. Yes, sir.
So that is what we call proactive.
Yep.
Before the thing
Yep.
happens, we try to do it proactively. We try to forecast
Yeah.
and do it, right?
Yeah.
So,
Yes, sir.
what do you think is more important, feedback or feed forward?
Feed forward is important, sir.
Yeah, feed forward is important, but I would say equally feedback is important. Both are
Okay,
important.
sir.
True
Yep.
enough, feed forward is
Okay,
all
sir.
right, but we must look
Okay,
at the
sir.
past to see what happened.
Yeah.
We can't ignore the
Okay,
past
sir.
and go for the future. We must look at what
Okay, sir.
happened also, and also we must be looking at what is happening or what is going to happen.
sir.
So both are
Uh-huh.
equally important.
Okay.
Can you give me an
Okay, sir.
example of feedback control? Can you give me an example of feed forward control?
So feedback is for variance analysis, sir.
Yeah, it's a budget, isn't it? Right?
Yeah.
The
Yeah.
budget
Yeah.
is a feedback control.
Yes, sir. Yes, sir.
Can you think of a
Then
feed forward control?
feed forward control, maybe cash flow analysis, sir.
Very good. Not cash flow
Okay.
analysis, cash forecast.
Okay, sir.
Cash
Okay, yes, sir.
forecast.
Cash flow.
Analysis is
Yes, sir.
past.
Yes.
Cash
Yeah.
forecast.
Okay. Okay,
You
sir.
prepare a cash
Okay, sir.
forecast
Okay,
for
sir.
next 6 months because you don't want to wait till
Yeah.
the end. You can't do a
Okay,
feedback
sir.
control with the cash. You can't
Yes,
wait
sir.
till the end and say, oh my God, things have
Yeah.
gone wrong. Now we don't have cash. What to do? So you have to
Okay,
always
sir.
go on the feed forward. You have to
Yes,
see
sir.
what is going to be happening in our cash in March. And then
Okay,
see,
sir.
okay, according to the present forecast, we are going to end up with a shortfall. In that case, quickly run
Yes,
to
sir.
the bank and arrange a bank
Yeah.
overdraft. Otherwise, we will not be able to pay the
Yes.
salaries.
Yes, sir. Yes, sir.
So the cash
Yep.
forecast is always a feed forward. You can't go on the
Okay, sir.
variance and say, my gosh, we don't have cash now. We are running into adverse thing now. What are we going to do?
Yeah.
Right? The employees will
Okay.
come to the
Okay.
office and shout and scream. So you can't wait. So this is what the importance is. So both these types
Okay,
of
sir.
controls are very important. Feedback is
Okay,
where
sir.
you measure the difference between the planned output and the actual
Okay,
output
sir.
and then modify for the future period. You can't do for the past.
Okay, sir.
Past is gone.
Okay, sir.
But immediately you can
Yes,
say,
sir.
hey, you have not achieved, you have to do it. You have run over cost,
Okay,
you
sir.
have to reduce the cost. Right?
Okay, sir.
Feed forward is always, it is a
Yeah.
forecasting the differences between what is planned and what will become
Okay,
the
sir.
actual, and then see
Okay,
what
sir.
are the things what we do to make it proactively achievable, to prevent such
Okay, sir.
gaps happening.
Okay, sir.
So generally, the most of us, including all of us accountants, we spend lot of time in feedback. Because feedback is
Okay, sir.
factual information. Factual.
Okay,
Right?
sir.
We have the last
Okay,
month's actuals. We have the last month budget. So we can easily prepare and say, you have gone wrong here. You have gone wrong there. You have gone right here. All that we can give it. Feed forward is not very easy. Because today when you
Okay, sir.
prepare the cash flow, you might say March end, we are going to end up with a deficit. But tomorrow when you prepare
sir.
the cash forecast, you might find something is going to happen and it is going to be a positive. So because of that, the feed forward is more difficult and feed forward will have more uncertainty
Okay, sir.
all the time because we are focused in the future. Future means always
Okay,
there
sir.
is uncertainty. right? Rain can come, tsunamis can come,
Mhm.
storms can come, and your plant can go really out of touch. So
Okay, sir.
changes will be very continual, and therefore it's
Okay, sir.
not easy, and it is going to take lot of management time.
Okay, sir.
And also it can cause lot of frustration because the management also can get confused. Now you are accountant in an organization. Today you tell end of April it's going to be a positive cash flow.
Mhm.
And you prepare the
Okay,
best
sir.
forecast and you say we don't have to worry, April we can pay a bonus and it's a positive cash flow.
Mhm.
Day after tomorrow you come to know your biggest customer who has to pay some
Mhm.
money in the 1st of March has gone bankrupt.
Mhm.
And now you prepare
Okay,
a
sir.
cash flow forecast and say by end of March, we are going to have a negative cash. So the management will ask, yesterday you told us positive cash flow. Today you are telling negative cash
Okay,
flow.
sir.
What's the meaning of this? So it can be very
Okay, sir.
frustrating for all the people when you go on a feedback system. Sorry, feed
Okay, sir.
forward system.
Forward, yeah. Okay,
But
sir.
we know every manager should be looking at future all the time, and
Okay, sir.
whoever who is going to ignore feed forward will contribute towards downfall of the company.
One of the
So in other
yes.
words, feed forward is also important. Feedback is also important.
Important. Yeah.
This is what the board of directors are doing in companies. This
Okay,
is
sir.
what the risk management strategy is. All the time you should be looking for feed forward. You must be looking for feedback. There are
Okay,
different
sir.
types of feedbacks. I'm talking about the feedback.
Okay, sir. Okay, sir.
The number one is what I call the primary feedback, right? So
Okay,
primary
sir.
feedbacks are, at the end of the month, you find little things that has gone wrong. You inform the line manager, not to the top. You don't go to the top and inform that, sales are dropped by 5%, all that. You inform the line manager through your management information system, through your management information
Okay,
reports.
sir.
You tell the line manager, look here, your things have not worked very well. There is a little bit of a deficit in your area. Please correct. Right? So you don't change the standard. You don't change the plan. You keep the plan, but you
Okay,
give
sir.
information through primary feedback to change their course of action so that they will come right. What
Okay,
is
sir.
secondary feedback? Secondary feedback is where you send information to the higher management. The idea is you change the
Okay,
plan.
sir.
For
Okay, sir.
example, right, you have a plan to achieve 100,000 sales, but you find suddenly a competitor has walked into the market, and because of the
Okay.
competitor's actions, you can't do 100,000. Now, if you keep the 100,000 target and ask your salespeople, hey, where is my 100,000? Where is my 100,000? They will get frustrated. You also will not achieve your result because you know they can't achieve it.
Okay, sir.
The reason is the competitor has brought some goods from China and has dumped the market. So what have we got to do?
Okay, sir.
We have to review the plan. We have to change the
Yes, sir.
plan. Now
Yes.
changing the plan cannot be done at lower levels. Once the plan is given, the change can only happen at the higher levels. And for that purpose, we give secondary feedback to the higher management so that they will
Okay,
decide
sir.
to change the plan.
Okay,
They
sir.
will say, okay, 100,000 is not achievable, make it 80,000.
Okay.
Sometimes it's the
Okay, sir.
other way about. You had a competitor,
Okay, sir.
and because of the competitor, you thought of selling 100,000, but suddenly the competitor went bankrupt. And now you can sell 130,000. So you change the
Okay,
plan.
sir.
You change the plan and tell
Okay,
the
sir.
fellows, look here, your competitor is not there, and now you must sell 130,000.
Okay, sir.
That's what we call secondary feedback.
Okay, sir.
Now another one, this is a famous examiners area, negative feedback. What is negative feedback? Negative feedback is you look at all the wrongs that what happened in your plan execution, right?
Okay,
Plan
sir.
execution. So we will look
Okay.
at all the things, and the ultimately what will happen is it will result in amending the inputs or processes. So output you are not going to change. Your target is not going to change. Right? Your target is to
Okay, sir.
sell the 100,000, but you might change the
Okay.
inputs or the way that you sell the way. You might open up another new channel, right? Something to achieve the output. So you look at all your errors or the negative side of it and try to correct it so that you achieve your plan.
Okay, sir.
That's what we call negative feedback. What is positive feedback? Positive feedback is you are not going to change the inputs, you are not going to change the process, but you go and change the output, right?
Okay, sir.
That is because you have done so well. Now you want to maintain that well, or when you want to do better than what you have done. So you go and change the targets towards upwards. You look at the good things what have happened, the positives, and then you try to correct your plan to sustain the positives and to achieve the positives. Now, this is not something most of the people will not like it, right? Because the people don't like when you try to increase the targets. Generally, they resist it. So this is what we call positive feedback.
Yeah.
Then there are two systems working. One, what we call open loop system. Right? You have a system. What is a system? Input, process, output.
Yes, sir.
Right? Where externally you can open the system and you can have an outside involvement. For example, your system says the credit is given only for 30 days for any customer.
Okay, sir.
But your director can open the system. Director has the authority to give a special credit period for Kumar going up to 45. That's what we call an open loop system. The system gets opened with a third party involvement.
Sir, I'm unable to understand, sir, this one.
Yeah, basically, your system says only 30 days credit is given to the customers.
Okay, sir.
Right?
Okay, sir.
But it gives it gives the manager or the director a kind of an exception where you can open the system and give another 15 days credit more to a particular special customer.
Okay, sir.
System says if you sell, if any bill over 100,000, it will give a 10% discount. But system permits you to open the system and give to a special customer a 15% discount. In other words, the manager is given few options to open the system and to make certain changes to the system.
Okay, sir.
That's what we call an open loop system. Open loop. Now, if you look at our SEMA exams, immediately once you sit for the exam, you get what we call a provisional pass or a provisional failure.
Yes, sir.
Right? But after 3 days, 50 working days, they will confirm that pass or fail. So I have had some students who have failed on the provisional, but in the next stage they have got through the exam. That is, they allow the examiner to open the system, go through the paper of Jayakumar, and to see whether we can pass the boy. Right? He has got 69, just one shot or whatever, and that they can pass it.
Okay, sir.
That's what an open loop. Open loop system means it allows a human being to enter into the system and change the system. What is a closed loop system? Closed loop system means no changes are possible.
Okay, sir.
The system itself will reject, accept. Now, you know, when some certain countries, when you apply for visa, there is no human involvement. You put all the things online, and the letter will come or the response will come saying visa is accepted or visa is rejected. That's a closed loop system. No third party involvement. The computer will decide whether he should be given visa or not, depending on the answers, depending on the documents you are given. That's what we call a closed loop system. Now, when I was working in a company, we had a closed loop system for the budget, right? We are all of us are given a particular allocation for petrol, all that. The moment it exceeds that one, you can't put any payment vouchers and get any more money. It's closed. System is closed. No one can open it. So that's a closed loop system. So it's a good thing. It brings a better control but sometimes open loop systems are also necessary to bring that human element into the controlling system.
Okay.
So this is what we are talking about, the management controls. So basically, the management need to put certain controls to ensure that they achieve the objectives. So generally, when we talk about the management of a company, we talk about the board of directors at the highest level. Strategically, they are the people who are responsible to achieve the objective. So they have to have a certain control system to ensure that they achieve the objective. So the management control is defined in SIMA as the process of guiding the organization into a viable pattern of activity in a changing environment. We know all of us live in a changing environment. So in a changing environment, the organization need to be guided to achieve a viability or profitability or good results, I would say.
Okay.
So to do that one, we must have a management control system. Management control system is the process by which managers attempt to ensure that their organization adapts successfully to changing environment. So the key word I want you to underline is the changing environment.
Okay.
Changing environment, because we live today in a modern business world, which is sometimes we call it world-class manufacturing. It is all about the changing environment. Compared to 30, 40 years back, the business world is changing every minute, every second. Some new product is coming up, some new technology is coming up. So we have to be completely alert, agile to the new things that is happening, to the environmental changes. So the way that we are going to manage that one is what we call a management control system. So what are the behavioral implications of a management control? Now you and I know any control we don't like it. People don't like any control, isn't it? When your parents put controls, you don't like it. When your bosses put controls, you don't like it. When you put controls, your students don't like it. No one likes the control. But we know without controls, nothing will happen also. It's a kind of a psychological thing. You know, this is where the good managers and the bad managers can be separated. Some people, they know, even though the controls are unpopular, they know how to get through the controls, how to ensure the controls are properly adopted. Some people, they are weak managers, they don't know how to do that one, and they can fail. So we SIMA accountants we have been taught to know, and to do that, we should know the behavioral implications of the control. So to have any control thing working, you must have targets. So this is what we generally call key performance indicators. Key performance indicator. Every manager must be judged not on his face or not on his height or anything like that, on targets that is given, and he must be judged only on his targets. This is where some companies fail. You know, they have their favorites. The favorites, you know, it can be a lady, it can be a nice lady or whatever, and you know, whether they work or not, they are being favored. Now this is not very good. That's not a good control system. The control system should not be looking at the face of the person, should be looking at the person's capabilities, give her a target, give him a target, and the main concern will be to achieve the target. Generally, when you are given a target, what happens is you will be very much focused on it on a short-term basis. So that can be a big problem where he's not going to look at the long term. If you are given a target for 2017, you will be somehow want to achieve the 2017 thing. I hear a lot of sales reps in the company which I worked earlier. We used to give them a monthly target. Their idea is somehow to achieve the monthly target. Sometimes they will backdate the sales and sell till 3rd March 4th March to achieve the February target.
Okay, sir.
So that can be a problem. So they will not be concerned about long-term consideration. So this is one of the problems of the control system.
Okay, sir.
And if the targets are given all in financial terms, he will completely ignore the non-financial considerations. Now,
Okay, sir.
where do the non-financial considerations come, Jay Kumar? What is the tool we use for non-financial consideration?
Sir,
What is the tool we use for non-financial consideration?
not, do not know, sir.
The balance scorecard. Can you remember?
Yeah.
Huh?
Yeah, Kaplan. Yes. Yes, sir.
Yeah,
Yes, sir.
balance scorecard. It has
Yep.
financial perspectives as well as three non-financial perspectives.
Yes, sir. Yes, sir. Yes, sir.
Yeah, in P2 you would have come across that one. What are the non-financial? Customer perspective, internal business
In terms of
perspective, learning and
innovative
innovation, and
yes, sir. Yes, sir.
financial. So if
Yes,
you
sir.
tell your people, if you set targets only on the financials, they will not be bothered
Okay, sir.
about quality. They will not be bothered about
Okay.
staff training. They will be not bothered about improving the product. They will just try to do at the minimum cost something. Whether the customer is happy or not, they will not be bothered. They will just do. So
Yeah.
that is why there is a growing need, growing concern. We must put non-financial targets also.
Okay, sir.
But when we do that, we have another problem. When you are being judged on too many targets, you can get confused. Right?
Okay, sir.
You have been told to achieve finances, on the other hand, you have been told to look after your employees. On the other hand, you have been told to look after the product. You might get confused. So that is why whenever we have a balanced scorecard system, we must train people to achieve that overall overview. So this is why today P3 examiner wrote an article sometime back. He said these non-financial measures. What are the non-financial measures? Customer
Yes, internal
perspective,
perspective.
customer,
Internal
internal,
perspective.
and learning and innovation. He said
Yes, sir.
if you focus on those three areas, the non-financials, he said the financial success will just automatically follow.
Okay, sir.
Right? Because if you look after your customers very well, if you look after your employees very well, if you have a good product, what he said was the people will just come and your finance revenue will go up, profits will go up. So he said the first three measures, the non-financial, he call it lead-in measures. Lead-in.
Okay, sir.
Lead on that one. And once it is lead, the financials will just follow. He called it lag-in measure. Lag-in.
Yes,
it is
sir.
coming just behind. During our time, we were taught the other way about. We were always told to look after the financials. So the board of directors are talking all the time about the financial. How much profit did we achieve? Why cost went up? Cost cutting, cost reduction, cost control were the subjects at that time. But today we look at from a different angle. We look at how much our customer is satisfied. How many new customers did we get last month? How many training programs did we carry to our staff? How many staff left? What are the new products we launched? We are looking from a different behavior now.
Okay.
So that's the management control system we should be looking at. And also, if performance is judged on profits, he might ignore the risk and take high risk decisions. Right? So you remember we said the other day when we were talking about, we said low competitive advantage, low high risk, we must avoid it.
Yeah.
But if you're going purely on profit as a target, even he will take those high risk ones and do it. If you take lots of high risk ones and don't have proper risk management strategies, your company can collapse.
Yes.
So we have to be careful. We have to be careful when you give this task to the people. Right? He will be, and also what happens is when you have this divisional setup, right? Now you have a finance division, you have your, now if you are in a lecturing thing, you may be having accountancy lecturers, then there may be economic lecturers, and the people are divisionalized in various divisions. So when we had divisions, sometimes divisions work in isolation, selfishly, without looking at the other division.
It's a dysfunctional.
Yeah, that is what we call dysfunctional, and that also can be a problem. So because you are concerned about your division, so you are not bothered about what's happening in the other division. You only want to, because your division profitability, you make a profit, so you make a bonus. You are looking for that kind of a thing.
Yeah.
And in P2, you would have learned something called transfer pricing. So one bigger problem will be this internally priced product. From one division to the other division, product is priced internally, and there can be a lot of confusion, lot of tension because of this internal transfer pricing.
Yes, sir.
If the targets are very, very ambitious, the people will not be going for targets, they will get demotivation. Demotivated. I remember I was working in a company, on every 1st of January, our managing director used to call us and give us a piece of paper. And that piece of paper says, you know, at the end of the year, you will be rewarded 10 million, 15 million, all that kind of a thing. But he almost puts, he puts almost impossible targets. We know we can't even think about it. So as soon as we come from his room, we destroy that paper. We don't want even to look at that paper. Because, you know, we know it's not worth trying to go for it. So if you try to put very ambitious targets for the people, which they cannot achieve, they will get demotivated.
Okay, sir.
You must put not very easy targets also. If you put very easy targets, then people will not get motivated. You must put what we call challenging targets. Not too easy, not too ambitious. Challenging targets. That's what we should be looking at. Right? Also, when we put targets, there is a kind of opportunity for them to manipulate short-term cost or profits. Right? I remember sometimes when we put certain targets on them, what they might do is they might not employ a fully qualified CIMA accountant. They might employ a half-qualified person to get the work. Short-term, they are all right. But the quality of the financial reporting comes down. He can't contribute towards a strategy because he doesn't have the knowledge. So overall, long-term, your things are down. But short-term, yes, we have saved a lot of money because we are not having a fully qualified accountant paying big money. We are having a man with lower this thing. If you allow the people to set their own targets, they do something what we call slacks. Build up slacks. What is a slack?
Slack means, for example, if suppose if I am a sales representative, say if they ask me prepare, then I will, suppose 10,000 is possible, but I will fix as 8,000, 6,000 like that.
Right, yes, you build up certain gaps into the thing, so you can be very comfortably achieve the budget, achieve the target. So that is why we say the budgeting or the controlling should be done in consultation, right? Get their views also, but don't give the 100% to them, because if you give it to them, like I think yesterday or the yesterday there was a question, the production manager was given the right to prepare the production budget. Obviously, he will prepare with lot of slacks. He will prepare with lot of slacks. So this is a dangerous thing. To be careful. So to do all these things, you and I, we as management accountants, we must have a management accounting control system. This is the original CIMA, and even now CIMA is working on this one. We as management accountants, we must provide information that will help managers to make good planning and control decisions. So our information is a very, very vital tool for them. You remember I told you there are two things for a successful company to go through. One is good information, right? Without any information, without good information, without timely information, the company will not be able to make right decision. What is the second one what we do? What we need?
Knowledge, sir.
Knowledge. Yeah, knowledge itself is not good enough. You need something more than that. That is what you told me, you have read. That is good corporate governance. It's not only knowledge, it is proper direction and proper control. Corporate governance, having right people. You can have the most knowledgeable people, but dishonest people. Right? So you need to have the right people in the organization, and also you must have right information. Generally with those two, the company should do well.
Okay, sir.
So a management control system will differ from one organization to other because the circumstances can be different. You can't have a standard control system. You may be working in a manufacturing company. You may be working in an educational institution. Another person may be working in a lawyer's firm. Another person may be working in an IT firm. So depending on their needs, we have to define the management accounting control system. But whatever the system we have to have certain common factors. One of the things for any organization to succeed or fail is to have a proper organizational structure.
Okay, sir.
So there are a couple of organizational structures what we know: functional, divisional, matrix, and network. Your controls will depend to a great extent on your organizational structure. If you have in a functional system, finance divisions, finance function separately, HR function separately, your control system will have to be on that one. Right? So, information should be given to the manager who is responsible, and they should be held responsible only for which they can control, and this is what we call principle of controllability. Don't give information and ask questions from people who have absolutely no control. Now, for example, one of the things what we do is the head office rent, what we pay, we might apportion it to each of the sections. Right?
Yes, sir.
Finance section, HR section. But that man, finance manager, has no control over that rent. So don't ask him a question why rent has gone up. He can't answer because he is not responsible for the control. So principle of controllability is a very, very important one. You must ask now for example, when the transfer pricing is set by you at the head office, and if you tell me you have to transfer Kumar at this cost to the other company, other department, don't ask me why you are transferred at that price.
Okay, sir.
Right? Because that you can't, he is not responsible. When the price is set by you to sell, don't ask why you are selling at that price. But if the price is under my control, set a price and ask why you did not sell at that price.
Okay, sir.
So, couple of measures of performance we have for each division. One thing is what we call return on investment. We look at the profit, we look at the capital employed, and then we have something called return on investment.
Yes, sir.
So generally we take the profit before interest and tax and divide it, and when we take it. Then we have another way what we call residual income. Now what is residual income? Residual income is we look at the income that that particular division has earned, but we charge something what we call notional interest on the capital they have employed. Now for example, your division has earned 100,000 profit. My division also in the same company has earned 100,000 profit. Right? Or both are equal. So when you look at like that, they're equal. 100,000, say, Jayakumar section.
Okay, sir.
Jayakumar section, 100,000. Kumar section.
Okay, sir. 100,000.
120,000. So if I look at like this, Kumar has done very well, right? But let's assume the assets what Jayakumar is using company assets only 500,000.
Okay, sir.
Kumar is using 1 million worth of assets.
Okay, sir.
So when you look at just like the profit, Kumar has done very well. Oh, very good, Kumar. But now look at on the 500,000 asset, you have a capital cost, and let's assume the cost is 10%. So on the 500,000, 10% is 50,000. So your residual income is 50,000 after charging interest on the capital you use. Now see, Kumar, 1 million. On the 1 million, 10% is 100,000.
Yes, sir.
What is Kumar's profit? Residual income, 20,000.
Yeah.
So even though we thought Kumar has done well, he has used lot of companies' assets and lot of companies' capital is with him, and ultimately his residual income is only 20,000. So that is not very good. So that is what that will tell us. So next thing that I want to do is economic value added. That is a very not a complicated, but I need little bit of more time on that one. So we will do that part of it in our next session.
Okay, sir. Okay, sir. Sir,
yeah.
Residual income, sir.
Yeah.
In the residual income, which company is J is better, sir, based on the
J is better. J has a 50,000 residual income. That is after charging interest, still they have 50,000. K is only having 20,000.
Okay, sir. So which one is better, sir?
J is better. J is better on residual income.
Okay, so after deducting the residual income after deducting this notional profit.
After that, the notional interest, they have a profit of 50,000. Yeah. That is what we call residual income.
So that's based on the residual income, we are deciding which one is the best, isn't it, sir?
Correct.
Okay, sir.
What it says is, true enough, Kumar has made 120,000 profit, but he has used lot of our assets. On our assets, we have to pay a return.
Yeah, understood, sir. Understood.
Yeah? That is what it is. So we will look at the economic value next time when we meet. So when can we meet next?
Sir, it's up to you, sir. Even tomorrow also no problem for me.
Let's see.
Based on your time, sir.
Yeah. Yes. Monday. So far I'm free. Yeah, Monday is alright by me. You finish your work at 4 o'clock, no?
Yeah, 4:30 I will be in home, sir.
4:30 home, yeah. For the moment, I will keep 5:30 your time.
Okay, sir.
5:30 your time, my time 7 o'clock on Monday.
Okay, sir.
If there's a change, I will confirm it to you.
Okay, sir.
Otherwise, for the moment, I'm going to keep 5:30 your time, my time on 7 o'clock on Monday.
Okay, sir.
Right? Okay then. I'll see you on Monday. Let me know whether what areas you want to do.
Up to management control, up to this risk and risk management, no problem for me, sir. I understood more clear this one.
Okay, right. Thank you, right, okay. I'll see you on Monday.
Okay, thank you, sir.
Thank you.